Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show, Lenka Martinek, managing partner at Sustainable Market Strategies and Nordis Capital, will be joining us for the hour. Then in 30 minutes, Montreal-based travel monetization platform Stay 22 recently announced a $122 million growth investment from Summit Partners. We'll talk to the CEO of Stay 22, Andrew Lochhead, about this new chapter and some of the new challenges for the company. And we want to hear from you this morning on First Call. Reach out with your questions on sustainable investing, and we'll have Lenka answer as many of them as she can at the end of the show. Number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. The group of 7 energy ministers will meet in Paris today as they continue to debate a possible release of oil reserves to stabilize markets. Yesterday, the group said it is ready to take any steps to support the global energy supply. However, the G7 stopped short of calling for a release of stockpiles. Prices have declined sharply since U.S. President Donald Trump hinted at an early end to the conflict in Iran. AT&T will spend more than $250 billion U.S. over the next 5 years to build infrastructure in the U.S. The telecommunications company will focus on high-speed fiber connections and expanding wireless satellite coverage. AT&T's revenue growth has been helped by customers that subscribe to more than one service, and the American company is marketing itself as a one-stop shop for connectivity. Hewlett-Packard gave a revenue outlook for the current quarter that exceeded expectations. Annual profit forecast was also raised. The American company is seeing strong demand for its networking products driven by a boom in AI tasks. HPE expects the memory chip shortage to continue well into next year. The hardware company is raising prices, in some cases even between when it quotes prices and when it ships products. And now our top line story. Oil tumbled after U.S. President Donald Trump said that the war there, will end soon as he faces mounting pressure over the conflict that has upended global energy markets and sparked concerns about an inflation crisis. The global benchmark, Brent, fell as much as 11% before clawing back some losses after a dramatic day on Monday that saw the biggest intraday price swing on record. For more on this, let's bring in our guest for the hour, Lenka Martinek, managing partner at Sustainable Market Strategies and Nordis Capital. And Lenka, thank you very much for joining us today. Initial thoughts on what is unfolding pretty much over the last 24 hours. It's been a wild one.
Yeah, I mean, initial thoughts. These are crazy oil markets. One of the things that is really fascinating is how the spread between Brent and WTI moves in, moves out as different countries, as we really unpack the fact, underscore again to what extent oil markets are extremely global. Supply chains are changing and will change in the future. So it's very hard to stay on top of this story as the tweets and the comments from Trump change. Obviously, there seems to be less of a united front between Israel and the U.S. over the last 24 hours. But it's obviously a story that continues to unfold as we speak.
And this really does show the vulnerability of oil in our world. I mean, when one strait can pretty much almost cripple the rest of the world with this. Is this opening up options for people to look at other sources again? I mean, I know Trump has moved away from it. Drill, baby, drill is what he wanted to do. But are people having a rethink about other options?
Yeah, so this is one of the points that we make quite a bit at our shop at Sustainable Market Strategies, is that every time we go through a period of oil uncertainty or oil volatility, it actually bolsters the case for non-fossil fuel sources of energy because of these very challenging supply chains within the oil markets. So I think you're absolutely right. If we go back, to the beginning of Trump's mandate, we know that Trump is not a believer in climate change. He promotes coal to as much as he can. Recall that he got elected on a platform of drill, baby, drill. But in fact, every time we go through an oil spike, I would argue like the one we're going through now or in 2022, what we see is that these sentiments about the necessity for countries to be increasingly energy dependent, energy independent, or to wean themselves off of volatile, geopolitically difficult sources of oil becomes increasingly stronger. And so actually we can go back to the 1970s, and the beginning of solar panel industry actually came from Europe during the 1970 oil crisis at that time. And so again, when we look, the last time we had an oil spike, it was actually 2022 when we got oil prices over $100 a barrel. We had this sort of epiphany in Europe that the energy dependency on Russian natural gas was far too high. And so we had this push for increasing energy resilience. And so what I think the politics or the geopolitics do in this environment is it actually bolsters the case for countries like China and elsewhere to try to wean themselves off of the major oil companies, oil sectors.
Are we at a point where we can start doing that? Is the reliability there? I mean, we got away from nuclear. Canada led the way in nuclear at one point. Can we regain that? And are the alternatives there to replace oil?
So one of the things that I think is actually kind of fascinating is when you, I don't know about in your studio, but the water cooler talk here is very different now than it was in 2022. So in 2022, there was no, you would get when we got to, gasoline prices at the pump, very similar to where they are today. Nobody was talking about, this should have bought an electric vehicle. And so I think now that some of the technologies that, through the last few years of electrification, I wouldn't say it's going to be an easy job to, we'll never wean ourselves off of fossil fuels completely. But I think the options do increasingly exist. If you look at the solar panel output, the solar power output from China specifically, that has just been ramped up enormously. So options exist. We can talk a little bit more about nuclear. We'll never get a full, I don't think it's not on anybody's radar that we're going to get some sort of full weaning off of fossil fuels. But certainly there are many countries in the world where their energy sources are far more diverse than they were the last time we had these types of big energy spikes.
And with nuclear, I mean, is it something that almost could replace oil, at least when it comes to creating electricity? But people still have this fear of it, don't they?
Yeah, so I would say the environment that we have been in since 2022 is really what I would call an era of all energy. So we'll take what we can get. The geopolitics oil is one aspect, but of course we can't forget the enormous amount of energy that data centers, that artificial intelligence will require. And so we've seen this right over the last couple of years that we've had this massive sort of rush to seize on really any available energy, including nuclear. So it might be a bit odd for somebody in the sustainability investment world to be talking about nuclear, but I actually think that this is a very important source of what I would call relatively cleaner and relatively safer energy than some of our other alternatives. Okay. So I think the announcement last week with the deal between Cameco and India is very representative of the type of environment that we live in today, where countries are seeking out energy sources, and nuclear will definitely be part of that energy mix.
All right, we have to wrap it up there, but lots more coming up. But thanks for joining us, Lenka. We'll take a look at the markets before the bell. All right, let's see how things are shaping up on the markets. We'll start with the U.S. futures, and there is still, of course, a lot of uncertainty from Iran, inflation, the Fed, all those things weighing on it after that rally yesterday on word from Trump that the war could be ending. But you can see today, we're back in the red. All of them around 0.3 to 0.4% is what they're off by right now. Asian markets, though, different story there. They all were surging today. You can see the Nikkei up by 2.88, Hang Seng 2.17, little optimism there, of course, and CSI 300 up by about a percentage point, 1.1. And Europe, similar situation, the optimism ruling there. The FTSE and the CAC 40 both up by 1.42%. And the German DAX up by more than 2%. All this over optimism that there is a resolution to the war in Iran. And next up, the TSX from yesterday, like everybody else, finished in the green, up by about 0.32%. The tech sector surging, offset though by a hit in the financial index. Some of the movers yesterday, let's take a look. Celestica up 7%, Methanex up by 6.5%, Badger Infrastructure 3.5, 3.6, and Curaleaf, Badger was down by 3.55. I was getting excited and optimistic about that. And Curaleaf also off by about 5 percentage points. And taking a look at the metals, all of them on the plus side today. You can see gold's up, pushing towards 5,200 again, up by 1.5%. Silver surging again, the roller coaster, 4.5% there, up to 88. And copper up slightly, a half point at 588. And of course, Western Canadian Select yesterday, after that wild ride, ended up still 4.88%. And WTI today, it's calming down. It's right around 90, just hovering there. It's off by about 5% after a wild surge and then the pullback yesterday. The parents of a girl who was critically wounded in the Tumbler Ridge, BC mass shooting have filed a civil lawsuit against the artificial intelligence company OpenAI. Now, OpenAI had confirmed a ChatGPT account connected to the shooter was banned last year and that the company considered notifying police about concerning interactions that violated its policies, but ultimately chose not to do so. Our guest this hour, Lenka Martinek, managing partner at Sustainable Market Strategies and Nordis Capital, says AI companies like OpenAI will require some private sector safeguarding, not the government. Why is that?
Yeah, so maybe I'll just take a step back. And in our shop, when we look at artificial intelligence as an investment theme, we look at it through two lenses. So the first being the companies like NVIDIA and OpenAI or Google, Anthropic, et cetera, that are actually building the inputs and the models. And the second category of companies that or themes that we look at are the second derivatives. So the companies that will or the industries that will either win or lose from artificial intelligence adoption. And one of the areas that I think that is being critically underlooked is governance. And so, unfortunately, from what the tragic event in Tumbler Ridge, what is coming out is, of course, that there has been probably a lack in governance and or a regulatory structure coming from governments and how these models are going to operate and be managed and tested, certified, et cetera. And so, what I think is playing out in real time is that we're clearly seeing that artificial intelligence adoption is happening much more quickly than the regulatory backdrop the official sort of government regulatory backdrop can keep up. And so I think the main parallel that we see here is actually that there's a place for the private sector will most likely have to step in at some point. And what we're seeing is, I think for me, the parallel really comes from the manufacturing sector. So we're all aware of the ISO 9001, for example, quality assurance in manufacturing supply chains. And I think it's the same sort of a system that will probably take hold, but is already starting to take hold in terms of artificial intelligence management systems. And I think that's where the opportunity in the short term is in terms of governance in AI.
But how long do you think that would take to put in place? I mean, how long did it take to get the ISO system running? It's been going a long time. And with AI evolving so quickly, is there not a danger that even private sector can't keep up? And how do we know that they won't do things that benefit themselves ahead of the public good?
Yeah. So, I mean, we never know that, right? It's always a question of what are the incentives. In the case of if we take the parallel with manufacturing, there was a strong incentive to ensure that that supply chains are efficient, that they're safe. Basically, it comes back to productivity, right? And so there's the same sort of. I think you could make the same argument in terms of artificial intelligence. That if you want to decrease, litigation, for example, you need to make sure that your models are strong, that that they've been tested, et cetera. And so coming back to the speed of this type of, again, the parallel with ISO 9001, actually the ISO organization, there is already a framework that is this out there that has been in place. It's the ISO 420001, which is basically for it's called the Artificial Intelligence Management System. And so the body of companies that are starting to actually, do the audits, use the management system are the same ones actually that are that are the big players in the testing, inspection, and certification industry. So think companies like Intertek, SGS, Bureau Veritas. Basically, these are companies that that are monitoring quality, whether it be in pharmaceutical chains, whether it be in the automotive industry. It's the same group of companies that I think will be responsible in the next 12 to 24 months in implementing management systems for artificial intelligence.
And how is that being greeted? I mean, we're talking about ChatGPT, what happened in Tumbler Ridge, but also we've got Anthropic saying no to the United States government. Do you think you'll be able to, with such disparate groups and there's a bit of a rebel streak, I think, to AI? Could you see them wanting to conform or play along?
I think that's a really difficult question to answer. I mean, as I mentioned at the top, it's a question of incentives. Why would an AI company want to to withhold them, to put themselves to a particular standard or not? Where is the pressure going to be coming from? Well, you're going to have groups like the families from Tumbler Ridge that are going to put pressure. The question always is, would you rather be self-regulated, or would you like the regulatory body to come from somebody else? And so I think there's a real incentive actually for artificial intelligence companies to show that they can operate in a responsible manner before that there is hard, heavy-handed regulation that comes through the pipeline by governments.
Okay, we have to take a break there, Lenka, but I love that discussion. Thank you very much for joining us. Lenka Martinek, Managing Partner at Sustainable Market Strategies in Nordis Capital. We're back to see why temporary employment firms are on her radar. Time to see what's on the radar for Lenka Martinek, Managing Partner at Sustainable Market Strategies in Nordis Capital. And we're going to talk about why temporary employment companies are showing up. Lenka, what are you liking about them, and any concerns?
Well, actually, there's not much to like about them, unfortunately, at this juncture. I think that for me, the reason why I wanted to flash this group of companies is actually as a bellwether for the overall employment backdrop. So again, let's take a step back a little bit. Big picture, of course, the U.S. employment number is probably the most important macro piece of data, monthly data for a lot of investors. And over the last couple of months, of course, we've had questions about the quality of the data because of the shutdown in the U.S. at the end of 2025. A lot of cross currents, again, coming back to the AI story. What are long-term layoffs versus what are the disruptions in the market? And so one of the areas that as a macro investor that I've always looked at is the signal that comes from the temporary employment sector. Because if we think about the jobs market, it tends to be the temporary layoffs and hires and fires that tend to happen quickest. And so we get a very, very quick signal from the temporary employment industry before you tend to hire or fire people on a temporary basis before you go through the long-term, the more costly long-term adjustment. And so if you just look at the overall, the official data, you always get kind of a turn in the cycle from the temporary sector before the broad one. And so then you can look at, the companies that are even more reactive. So the actual temp employment companies, what are they saying? How are their stock prices performing? And I think it's an important extra information on trying to understand what the U.S. job market is actually going through in real time. And so I think you might have the charts there for some of these companies. So think like Manpower, Adecco, Robert Half. These companies have been in a really strong bear market for quite some time. So basically, the stocks have done poorly for the last couple of years, and essentially we're seeing this sort of reflecting only now in really poor employment data from the U.S. And so these stocks are on my radar because I look at them as a bellwether for the overall growth or health of the U.S. employment sector, and I think that the message that we're receiving, whether it's through the earnings reports or through the actual stock price, is that there are some fundamentally difficult it's a fundamentally difficult backdrop for the labor market in the U.S., which of course is highly important for the next couple of Fed meetings for sure, as we're in this environment where we potentially will have more pass through from oil prices into inflation. And so so I think it's a great indicator to look at for investors who want to have a second kind of view about what the employment market is like.
And does it show up as a bellwether for AI as well, and the impact AI is having, or a lot of these temporary employment jobs, actual physical jobs that can't really be replaced with AI?
No, not the case necessarily. A lot of these companies have different parts of their businesses, and so they're going to have, as you mentioned, sort of maybe, the physical jobs or blue collar jobs that are more difficult to replace by AI. But you also have an awful lot of service jobs, whether it be executive searches and this type of thing, and also a lot of white collar, office jobs, which very much we know now can very much be replaced by AI. And so when you look through the earnings reports of all of these companies, there has become, it's just fascinating. And, none of these companies were reporting on AI 18 to 24 months ago. And now all of them in the Q&A section, there is always questions about what is AI doing to your business? How are you able to integrate AI, but also what is the job destruction that is coming from it? And it is definitely apparent in the earnings comments that some sectors that, at this point you would expect to be stronger have been notably weak. And so, as I mentioned, the white collar, the sort of office jobs that can be, companies are just a little bit quicker to fire or to lay off, and not nearly as likely to enter into longer term contracts. And so you see this sort of uncertainty that's being built into labor markets as a result of how companies are thinking about how AI will change certain jobs.
Okay, we'll wrap it up there, Lenka, but we've got lots more to talk about through the next half of the show. Still ahead, we're going to be talking to Andrew Lochhead, CEO of State 22, on global travel and how the disruptions are affecting the creator economy as well. Our phone lines will open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email as well. First call at bellmedia.ca. Sales growth at TSMC coming up short in the first 2 months of 2026. Revenue for the chipmaker rose 30% in January and February, trailing behind the 33% increase estimated by analysts for the current quarter. This comes as the Taiwanese company shifts capacity to make more high-end chips that go into data centers, draining the production and supply of conventional memory chips used in smartphones and PCs. Canada will allow TikTok to continue operating in the country under new legally binding commitments to enhance its security. The social media platform will add security and privacy features to control access to Canadian user data. TikTok has also agreed to enhance protections for minors and appoint an independent third-party monitor to verify data access. Ottawa has not provided details on how the measures will work. G7 energy ministers chatting again today as they continue to debate a possible release of oil reserves to stabilize markets. On Monday, the group said it is ready to take any steps to support the global energy supply. However, they stopped short of calling for a release of stockpiles. Prices have declined sharply since U.S. President Donald Trump hinted at an early end of the conflict. That was late yesterday. Now, not everyone's convinced that there may be an end in sight. You can see U.S. futures after that green day yesterday. All of them in the red. The Dow off by nearly a half point, as too is the S&P 500. The NASDAQ off by about a third of a point. Montreal-based travel monetization platform Stay22 recently announced a $122 million growth investment from Summit Partners. It plans to scale globally amidst major travel disruptions due to the geopolitical tensions. Here to talk about this new chapter and new challenge for the company is Andrew Lochhead, CEO and co-founder of Stay22. Andrew, thanks very much for joining us.
Good morning, Roger.
Tell us a little bit about, first of all, what Stay22 actually does.
For sure. So what we do in a nutshell is we help content creators, publishers, and digital platforms better monetize their content. That might be on YouTube, on their blog, or social media as a whole.
And with this new money, what drew this in? What do you think landed that contract?
Mostly the team. I strongly believe that the Summit Partners saw the team has been going through the ups and downs of the roller coaster. So we survived COVID. We managed to make it through wars, geopolitical issues as well in the past. It's a fast-growing company. We've been able to about 20x in 5 years, and we're profitable. So I believe all those things were the main reason why Summit was interested in investing.
And why go the institutional growth investor route?
At our stage, VC didn't make as much sense. It's not about risk anymore. It's really much more about scaling the business to new height. And for us, that's the reason why we were looking for a great private equity with an amazing portfolio companies underneath. And Summit were exactly the partners we're looking for from day one.
And with 2025, you saw $1 billion in transactions. 2026 is starting out a little differently. How are you projecting the year? How are you dealing with what's unfolding right now?
I was just looking at your previous segment, and we already saw somewhat of a lower season than expected. Not as much as what we see for airline as well, so that might be more relevant to the fuel and costs, as you guys mentioned. But for us, obviously, a war will have a delay. The good thing is travel is probably one of the most relentless industry that exists. It's going to come back, and it's going to come back strong. So we're confident that maybe not this quarter, but definitely for next one or for H2 at least, the travel market will rebound right in time for summer.
And how do you? I mean, you had the pandemic. How do you deal with moments like, well, not even moments, situations like this? I wouldn't say a moment, but I mean, you came through the pandemic. How did you cope with that? And does that do you use that experience to apply to this moment too?
100%, Roger. We're supposed to only have one Black Swan event every couple of years. Unfortunately for us, it seems like we already got a meaningful amount of them during the same decade. We got the experience. The team's been through this as well in the past. We've lost our revenues, like 90% of them back in the pandemic. Then we lost about 80% when our suppliers went down. So we've been through those situations in the past, and we're just more resilient out of this. The team believed that we'll be able to pull it through, and that's the reason why we're still alive today and kicking it.
What did you do in the pandemic? Like, what did you change, or how did you adapt to survive?
We almost changed the full business model, Roger. So we used to be a map-based solution for event goers, and obviously in the pandemic, events and travel were not the right place to be. So we pivoted away from that to work within the content creators. Unfortunately for us, the product was not making sense at all for content creators, so that's when we came up with a new tool of solution for those. And this way we were able to provide them more freedom. So now they can spend more time traveling, creating content, instead of wasting their time behind their screen, adding monetization affiliation link behind.
And where do you see your growth coming from, and how are you going to grow it?
Yeah, so obviously we're expanding more into social media side of things like everybody else. We're taking advantage of what's happening in the AI world already. We've been in travel for the past 9 years of our life, and now we're expanding to retail as well. So Stay22 will be able to offer that type of like links, monetization skills, and human touch approach to all of the different segments as well of the industry. Think from like household all the way to like garden and law. So we'll have many more time and opportunities in market.
And how do you see retail benefiting from you?
Retail is doing pretty well. Retail is increasingly good for us. The reason why is people are definitely making more impulse purchase. When you purchase something on Amazon for $25, it's much different than planning for a trip that you take probably twice a year where you spend like hundreds of dollars. So for us, conversion rate is much higher, but obviously the commission is also lower. So it's more of a volume game for us.
And are you still doing events? Or how?
We still do events, but it's a small part of our business as of now.
And just out of curiosity, more so, does the Live Nation ruling, is there any connection to that, or any do you benefit from it at all, or is that completely separate?
It's a bit different. So we're working with most of the largest or all of the largest ticketing platform around the world as of today. So that's great, except for the United States. So that ruling is not impacting us yet.
Yet. Are you looking to the U.S. then?
Maybe it's going to be a great timing for us to expand into the event segment right now with that ruling. So obviously, the more companies, the less it's going to be granular in this, the more opportunity we'll be able to seize out of it. So yes, it might be a better timing for us to look as we want to expand.
And then Montreal's home. Are you staying there, or are you looking at another hub, Toronto, Vancouver, or are you going to stay in Montreal?
Just like the other great company in Montreal, from Plus Grade and Travel and Opera, we love exactly where we are. We have great 4 universities in here where we can actually great, amazing talent from. So we want to keep our headquarters over here. We're having over 100 people already in the office, so that's great.
And how would you describe Montreal when it comes to tech? Is it becoming a hub?
I believe it is becoming a hub. Maybe we've been on a slower pace compared to Toronto, so no big surprise, but I think we're slowly catching up, and it was about time because we definitely need the help.
Okay, Andrew, thank you very much for joining us today. We appreciate it.
Thanks, Roger. Have a good morning.
Andrew Lochhead is the CEO and co-founder of Stay 22. Still ahead, Defense Minister David McGuinty has announced new investments under Ottawa's defense industry strategy. We'll have more on the billion-dollar pledge and the promise of jobs to come after the break. And, of course, our phone lines are now open. Michael Martinek, managing partner at Sustainable Market Strategies and Nordis Capital, is taking your questions on sustainable investing. You can reach us at 1-855-326-6266 or email firstcall@bellmedia.ca. Canada's defense minister announcing new investments under Ottawa's defense industry strategy. CTV's senior political correspondent, Mike Lecouture, has more on the billion-dollar pledge and the promise of jobs to come.
It's a $900 million announcement for defense innovation in Canada. The partnership with the National Research Council will help grow domestic drone and aerospace technologies.
This will allow us to develop new platforms for drone and aerospace technologies, including having a new drone innovation center, a drone innovation hub here in Ottawa at the NRC.
The federal government is also buying a new $500 million Bombardier plane. It's the same aircraft already being used by Saab and a Korean company for defense surveillance.
They're going to intentionally make their purchases in this country by design, by policy objective, and that's a huge reorientation of the way the government of Canada has worked.
It's a welcome change for the Quebec-based aerospace company, pointing out that particular model is truly Canadian-made.
Our aircraft, there's a lot of Canadian content. We have on the 6,500 over 65 suppliers in the country.
It's estimated close to 1,000 jobs are being supported by the purchase of the new Bombardier jet and 6 others ordered in December. The federal government's defense industrial strategy unveiled last month is promising to prioritize homegrown production and research as a way of keeping investment dollars and employment in this country. While it's unclear how many jobs could be created from the drone hub, there is a sense that it could spur hiring in related industries.
Working with the SMEs, that we are going to be helping them so that they can grow and their production, so that they can provide to defense in Canada, but also defense to our allies.
Defense industry analysts say the government's defense industry strategy is off to a good start. But some say if the Liberals want to deliver on their promise, they'll have to make a lot more of these announcements a lot more often.
All right, that was CTV's Mike Lecouture. And we have lots more coming up, including a look at some of the notable analyst calls and recommendations moving the markets, including Novo Nordisk. Stick around. Let's take a look at one of the notable analyst calls and recommendations moving the markets today. Novo Nordisk faces huge challenges, and it is no longer clear the pipeline can answer the call. TD Cowen writes in a note downgrading the pharmaceuticals firm to hold from buy. Analyst Michael Nedeljkovic lowers price targets to DKK 270 from DKK 280 and on the ADRs to 42 from 45. For more on the GLP-1 market, let's bring in Lenka Martinek, managing partner at Sustainable Market Strategies and Nordis Capital. Lenka, I was just looking at a number, 3 million Canadians are now using GLP-1 drugs. Unbelievable.
Yeah. So I mean, I think it's no secret now the GLP-1 drugs are pretty impressive stuff on many levels. Of course, if we go back a couple of years when we first started hearing about Eli Lilly and Novo Nordisk products, it was really an obesity drug, right? It was expensive. It was by injection only, and so the sort of addressable market at the time, going back 2 years, was rather small compared to where we are today. So again, key things to remember: difficult to inject, difficult to get it into your system, and very expensive drug. Only a couple of manufacturers. So Novo Nordisk and Eli Lilly. Fast forward to today, what is happening? So of course we now have Wegovy is now, I believe it's now approved by in pill form. So much more easily accessible in terms of getting it into being able to use it. The price point is dropping because there's more competition. But for me, I think the most important thing is that these drugs, the GLP-1 inhibitors, are now it's through clinical trials we're learning that actually they are valid responses, valid medication for a whole host of other illnesses. So think things like kidney disease, addiction problems, and so the total addressable market went from something that was fairly small, although obesity is very important, especially in North America. Problem that prevention or is the cost associated with the healthcare system are just enormous. So that alone is an incredible breakthrough. But when we think about the total addressable market today, I think it's much larger, and we can attack an awful lot of very important illnesses through GLP-1 drugs. So I think it's a very, very exciting environment. Obviously, Novo Nordisk is a particular story. The stock has struggled for a number of reasons. But if you took a sort of like a broader approach to the GLP-1 medications, I think it's a very, very exciting period.
And any worries that I think back to the Atkins diet and how that came in and people were getting injections with that. Any concerns this could come and go, or does it feel like this might have legs?
Well, I think we're already seeing that it has legs. As you mentioned, 3 million Canadians are already on this medication. Is it perfect? Are there side effects? Obviously, there are risks involved in all new medications, but as we go forward in time, I think there's a very large chance that this will become a medical approach, an option for an awful lot of different illnesses that we struggle with still to today.
And so where are you looking for opportunities from the investment side on this then?
Yeah, so our approach has actually been to hold a basket because, as you flash the chart for Novo Nordisk, we've had specific problems, specific challenges in individual companies. But if you look at so there's the ETF, the Roundhill ETF, OZEM, for example. It's a basket of about 25 companies that are involved in the GLP-1 space. So our approach has actually been to take no, don't pick a winner. Don't pick Eli Lilly versus Novo Nordisk, but say, okay, this is a medical breakthrough that will be around for some time. It's important. It's important from a social, from a sustainability perspective as well. And so you don't need to pick the winners. You need to pick the technology or the medication, let's call it, that will succeed, as opposed to the individual stock, the individual company.
Okay. Unfortunately, we don't have that chart, but we're talking about that. When we come back, though, Lenka, we're going to be talking about your questions on First Call, so get them into us, please. All right, time for First Call, time for First Email. It's from Glenn, and if companies start auditing AI models the way accounting firms audit financials, what would that mean for transparency and trust for everyday Canadians? Lenka.
So the way that I think about this is that when you analyze when you're looking at your stock portfolio, or when you read the annual reports of a public company, you more or less just assume that the information that you're reading is of high quality, that you can accept that the information exists. If you think about products, consumer goods products that you use in your everyday life, for the most part, I mean, obviously, every once in a while we have a negative surprise, but for the most part, you assume that the quality, that the safety of those things are high enough that you can use it without thinking about the risks to your health, or to your home, et cetera. And so, I think the goal with AI for everyday Canadians is that eventually, at some point in the future, by putting the correct backstops in place, we're in an environment where users of the consumer of artificial intelligence, whether it be, me as an individual or for businesses, can assume that the model is free from bias, is governed properly, that will not go rogue, so to speak, et cetera. And so the role of an accountant auditor is essentially that. It's basically to give us some sort of assurance that that a statement, that a banking statement, or a publicly held company is free from error.
Mm-hmm.
And so the parallel, I think, is that with AI governance or auditing, is it the same thing? That the goal is that when we end up consuming the underlying service, we can do it in a way that we're not thinking about, well, is this true, and is it exact? And so I think that should be the goal of where we're going in terms of AI auditing.
Now, do we have a watcher who watches the watchers? Is there a group that kind of oversees the groups that oversee industries and sectors?
Well, so again, if we take the parallel, with manufacturing or with accountancy, it's not true that we're free from, that the world is perfect. Like Enron, for example, it's not that far in our history to remember that we've had some pretty important accidents, but these are not everyday events, right? And so your answer to the question, who's watching the watchers? Well, in the financial industry, obviously, after post Enron, we had a pretty significant tightening of the screws when it came to regulate, like SEC regulation. And so there are those governing bodies in other sectors, and other countries around the world are starting to put in place IA regulation. So the most notable one is in Europe, the AI Act. It will start to be enforced, I believe, in the mid-2027. But in North America, I have to say that we're still lagging from a regulatory perspective. So eventually we will have, I think, government regulatory bodies. But in Canada today, there's nothing that is as being forced to my knowledge.
Okay, let's get another email in here. This one's from Jonah. With energy prices becoming less predictable, do you think nuclear energy is starting to look more attractive as a stable long-term option? And it is long-term. It's not something you can just ramp up tomorrow.
Yeah, exactly. It takes several years to go from the planning phase of a nuclear power plant to actually have it up and running. But I think the question, we could reframe it and sort of say, like, because I think this process has already been in place for at least the last 5 years. We've seen an enormous ramp up in the number of planned nuclear projects, not necessarily in Canada, but you see, I think the vast majority of projects that are in ramp-up mode today are both in India and China. Over the course of the last 18 months, we've seen many more deals in the U.S. Basically, companies trying to get their hands on more electricity for data center needs, and so that process has already been in place for some time. My argument today is that I see no reasons for that to slow down, and to the contrary, every time we have these spikes, these volatility events in oil, refocus the attention on what are our more reliable sources of energy going to be in the future. And I think nuclear is part of that package.
Okay, another email, this one from Amy, and it says, there are so many sustainability-focused funds now for someone trying to invest responsibly. Which themes or sectors are easiest to evaluate based on clear, real-world impact? I like that.
Yeah, that's a great question. And so I assume that part of this question must be coming from the idea that ESG, environmental social governance, as a investing tactic simply does not have the tailwinds that it had over from 2021 until 2024 roughly. And so what I always tell to people is that whether you're talking about sustainability or any other form of investing, you're always trying to figure out where you need to anticipate where the world is going next. What are the problems that are going to need to be solved? And so when we think about sustainability, there are some very clear ones. As I think we're in a world where we're shifting we're shifting away from climate mitigation to climate adaptation. So what I mean by that is that for the last 10 years, we've been talking about climate change is coming. We're going to have a climate problem. But where we are in the world today, we're seeing obviously much more frequent weather events. We're seeing flooding, we're seeing droughts. All of these things have economic consequences. And so we're not mitigating climate change. We're not going to stick to 2 degrees warming, et cetera. And so the physical consequences of climate change are starting to appear. And so I think the investment themes, the areas that we need to concentrate on are how are the physical consequences of climate change actually, disrupting markets. And so that can be, for example, the types of infrastructure that we put in place, going from a world of very concrete, asphalt, et cetera, to things like sponge cities. So different types of infrastructure projects. It could be this shift away from fossil fuels to electricity, to the electricity transition. But my main message would be to follow the track of the real consequences, what is happening on the ground today. And so that leads you to things like water scarcity, energy transition, critical materials, because things like copper are currently in short supply in order to electrify. These are the areas that I would focus on.
Okay, Lenka, we have to wrap it up there, but thank you very much for joining us today. We appreciate it.
No problem.
And that was Lenka Martinek, managing partner at Sustainable Market Strategies and Nordis Capital. She was here all hour. Andrew Bell is up next with the Open, and trading gets underway about 30 minutes from now. Should be another interesting day. Have yourself a great day.